DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
What's going on, guys? Welcome to episode 108 of the DeFi by Design podcast, our second rundown with Matt Cutler from BlockNative. We're going to be talking about a lot of things that are happening in the Ethereum world today, and some interesting educational concepts that I personally would like to learn more about. And we've got just the right guy. So what's up, Rob? How you doing?
GM, doing well. I just had some lunch, so I am full and ready to chat. I won't take any more time before we introduce Matt, who needs no introduction because he gave quite insightful one last time. I think rattled off like 7 or 8 startups that were some ups and downs, but ultimately we're here to stay. So Matt, welcome back to the podcast, man.
You bet. Thanks for having me back. Great to see you, Andy. Great to see you, Robbie, and excited to dive in.
Awesome. Andy, do you want to kick it off? I think there's some really interesting conversations that we can get into, and yeah, go ahead. First question.
Yeah, I think just what was interesting is that we last time that we had this pod, we were DeFi Slate, and now we've jumped on the scaling bandwagon. I would love to hear your thoughts as to if since the last pod we had maybe a year or two ago, year and a half, 2 years probably. How do you think the ecosystem is scaling from a TPS perspective? And is this kind of the modular and roll up world that you were expecting from that last pod? I'm just curious.
Well, in Web3, 2 years feels like a lifetime ago. So it's like we live in a completely new reality. That much is clear. I think that there was, back then there were, significant questions on what was scalability going to look like and how we're going to get there. I think the Ethereum Foundation provided a lot of clarity to have an L2-centric scalability plan. We've seen the rise of a couple of really major L2s, largely with Optimism and Arbitrum, but also, Matter Labs, EK Sync, and now things like Base and many more. And I think that the thesis is playing out pretty cleanly. There's still a ton of questions. We're still very early in the cycle, but net, I don't think there's any ambiguity around how Ethereum is going to scale, what it's going to look like, what the trade-offs are going to be. And what I'm hearing out there is, are there going to be a handful of rollups that matter? Are they going to be dozens, or are there going to be thousands? And most of the smartest people I know are very much in the thousands or tens of thousands of camp. And so it starts to get super interesting in terms of the diversity that's possible, the just the number of players, and also the complexities that emerge from it. We always say, like, do you pay attention to where the food that you eat comes from? You should, because it's sort of what you're made of. And then similarly, do you pay attention to how the transactions you're doing actually get on chain and get confirmed? Because you should, because ultimately settlement really matters in these systems, and they particularly matters as it relates to L2s. And so the L2 settlement is complex because you have to settle first on the L2 and then on the underlying L1. And there's a ton of interesting questions surrounding that. And then final point is Ethereum itself is basically making significant upgrades to facilitate this, with the next major hard fork coming up probably end of the year, beginning of next year, called Deneb, with EIP 4844 proto-dank sharding, which is really targeted at making life easier and cheaper for rollups. So they're putting their money where their mouth is, and we're underway, but there's still a lot of history to be written, as I like to say.
Yeah, speaking of EIPs, I think the last time we spoke, it was around actually the merge. I think it might have just been just after the merge, perhaps. But I know that you guys were super, super excited about block building in this new proof of stake model. For those of you who are unfamiliar, block building is like basically kind of what it sounds like, the process of building and creating blocks that are finalized and settled on Ethereum. Obviously, with proof of stake now, that's what we have. We have validators building blocks in the least technical way possible, building blocks and posting transactions. And so I know that's what you guys were super focused on, and you guys were making some good dough on that. But what's going on now? Where's the focus, and kind of what have you guys been leaning into over the last year or so?
Sure. So actually quite a bit of change here for us recently. So just over a year ago, Ethereum completed the merge. It was on September 15th, 2022. This was the transition from proof of work to proof of stake, brand new consensus mechanism, or brand new to Ethereum, I should say, proven elsewhere. But along with the merge came a number of fairly significant upgrades to the network that did not get quite as much attention because they're sort of less fundamental, a little bit harder to understand. One of those upgrades was known as PBS, or proposer builder separation. What this did was break apart the roles of proposing a new block to the network from building the block. So building the block is the act of basically deciding which transactions are going to get included and in what order. By the way, as part of that, you also can decide which transactions get excluded. And PBS basically introduced the opportunity to outsource block building to a network of independent third-party providers, with the reason being building blocks that are valuable, which is what validators want to do because they get rewards based on the more value that's in the block, is actually pretty hard. It's hard to build blocks. You need a lot of network, you need a lot of compute, you need a lot of storage, but really you need a lot of relationships. You need relationships with actors known as searchers, who basically are the trader-like entities that extract MEV. MEV is known as maximal extractable value, and it's the value that you can gain by manipulating and altering ordering. And so the thesis was that block building is going to be a specialized skill that would be problematic for independent stakers. Say, one of you guys with a staking rig in your house, machine underneath your desk that's sort of doing all of this. It's going to be hard for you to compete for block value versus large staking pool operators like Lido or Rocket Pool or others that have a large amount of economic resource that they could devote to this problem. So the idea was, look, if we create an outsourced network, then everybody has access to valuable blocks. And then larger entities don't have to build this capability themselves. And that's exactly what happened. Today at Ethereum, about 95% of all blocks are outsourced. And the reason why they're outsourced is because they're about 5 times as valuable as a vanilla block or internally sourced block. So there's great economic incentives to do so. At the merge, we were given what we had done historically, we work very closely with sort of real-time mempool data, and we have global infrastructure for that. And we evolved into being a block builder. So at the merge, we started building blocks on behalf of the network, and we started relaying blocks, or intermediaries between the validators and the builders. And we were really excited about that because there was a hypothesis that being a block builder would be this really interesting opportunity economically. Well, fast forward a year, and just last week, we announced that we're actually suspending our builder and our relay. And the reason for that is those economics didn't really materialize in the way that we, and I think many others, sort of anticipated. Namely that there's not a lot of value in being a block builder, because there's so much more value in being a searcher trader. And so the profits in block building go to what are known as vertically integrated searcher builders. So we're a credibly neutral provider. We're not a trading entity for a whole bunch of reasons. We don't have a big stack of capital that we use to make arbitrage bets on. But there are a bunch of actors out there who are. And what they were doing, because they want to make sure that their trades land, is they just became builders themselves. And so it turned out that the market for builders evolved in a different way than we anticipated, in a way that's much more verticalized and therefore more centralized than I think folks probably wanted. And today there's a handful of builders that really matter. Depending on external circumstances, there might be only one builder that matters, which is not great for the health of the network. If that builder doesn't like you, they can decide to not include your transactions, or that builder has a competitive strategy to you. So they have their trades versus servicing your trades, that they could censor the network or things like that. It's not ideal. But that's sort of where we are. We as BlockNative are a venture-backed startup. We're trying to build a real business out of it. And after a year, we've learned a ton, but we've decided that it's just not sustainable for us long term to either operate a relay, which by the way have no economics associated with it, or to be a builder. Instead, what we're doing is we're focusing yet again. And what we find in the current system is end user transactions are effectively second-class citizens, largely because these large trading entities are always competing for the best settlement, the most valuable position in block. And we don't think that's great for the long-term health of the network. And we have a lot of ideas and a lot of capabilities that can actually help regular users via wallets compete for optimal settlement. And so we're choosing to focus on the areas that we really think are most interesting and most relevant, which are really helping users have observability into what's going on, helping users protect their transactions from adverse settlement, and helping them get optimal settlement wherever possible. So, we're continuing to work really hard in the space. We're continuing to focus on all the interesting challenges of MEV. We're just applying our efforts in sort of a narrower area, and we're excited to do so in conjunction with our wallet partners. So a lot of change out there. Web3 moves quickly, and we have to move with it. So that's a long answer to a short question, but that's where we are.
Yeah. So it was mostly economical as far as the change goes, you'd say.
Yeah, there were many factors that went into us deciding to make a change here. Clearly, like the dominant one was effectively our investors are financing the operations of the network, which isn't great, right? Like, why are we spending investor dollars to make Ethereum run more smoothly when we're actually providing, value to all the various actors and to the network and network operations? We sort of felt like it's a reasonable expectation that we be economically incented to do so. That's not the case right now. And so we basically said we have to find opportunities where there are positive economics. But there are other reasons as well. We're a US-based entity, which makes us subject to what's known as OFAC SDN. So the US Department of Treasury has a thing called the Office of Foreign Assets Control, and they have this thing called the Specially Designated Nationals List, which basically, if you're a US person, it doesn't even matter where you're incorporated, but if you're a US citizen, you can't touch that stuff. The rules are pretty strict. It's $30 million per infraction and up to 30 years in jail. And so, that's something you really have to be careful of as a US entity. And unfortunately, just before the merge, the Tornado Cash smart contracts were listed as OFAC SDN, which basically meant for us, we couldn't really build blocks that included those addresses because we'd be in violation of some pretty serious regulations in the US. Well, there are members of the Ethereum ecosystem who viewed that as really problematic because that's censorship. You're basically deciding who can get on chain and who can't. And so we wound up inadvertently sort of between a rock and a hard place, where on one hand, we have US regulations we have to comply with. On the other hand, we're trying to be ecosystem aligned. And we're trying to square that circle. And even after some pretty extensive conversations with EF core devs, really found ourselves in a position we don't like to be in, where we really couldn't find a path forward that satisfied all the constraints. And we really do try to be ecosystem aligned. So it turns out to be cleaner for us to not do these things. I mean, we were like 10% of the network in many circumstances, and it doesn't feel great to say, in order to live our values, we're going to stop doing this for the network and we're going to contribute to centralization. But that was sort of the position we were in. As we look ahead, we care about observability. We care about things like everyone being able to see what's really going on. We're now a more credibly neutral player in that regard because we're not building blocks, and there's not any question as to, do we provide different degrees of observability or transparency for our blocks or our transactions versus others. So that's good. And then finally, we really do care about end user and end user settlement. I mean, we've been building an Ethereum ecosystem for 5 years with the idea that we're building the foundation of the next economy, and that next economy is going to be fundamentally better and more equitable than the existing economy. But when we have a network which fundamentally biases towards traders and for trader settlement at the expense of regular end users, it doesn't feel that equitable. It feels sort of like the existing system we have. And maybe that's inevitable. Maybe there's no way to avoid that. But we feel like we can do some things that are quite clever to actually help end users and sit on that side of the table. And so that feels a bit more values aligned to us. So, there are many reasons that went into us making this change. The biggest one is we have to find economically viable things to do, but that's not the only one by any means.
Bear market vibes. Rob, what you got?
Well, when I first got into the space, it was like you pay the highest gas, you get the best execution. but there is so many layers to it that it's no longer the case. And maybe it never was the case. While we enumerate like elements of this system, I'm curious to like, for my own edification of like understanding some of these components in the Ethereum machine. We hear a lot about sequencers now, and back then it was a lot about block builders. So has the model changed much, or is this just kind of like a new term for the same old thing?
That's a big question. So I think thinking and understanding here has evolved a huge amount. So it's sort of hard to dive into this without diving into MEV first. So MEV, I mentioned before, maximal extractable value, was miner extractable value, with the basic idea being financial systems are fundamentally ordered systems, meaning the sequence of transactions matter. And it turns out whoever controls the final ordering can extract value from the system. And today, MEV, the market is measured in billions of dollars per year, and it continues to grow. So the idea is whichever entity sits last in the ordering can extract billions of dollars by altering or selling the rights to specific ordering. And it's really pretty simple when you get down to it. Imagine there's an Oracle update. So Chainlink updates their Oracle, and the Oracle shows that the price of ETH has dropped a whole bunch. As a result of the price of ETH dropping a whole bunch, there's a whole bunch of collateralized debt positions in Maker and Aave and elsewhere that suddenly are under collateralized and available for liquidation. And whoever goes in and basically handles that liquidation is going to make a bunch of money, right? The issue is there's probably only one person who's going to do it. And so how do you become the one person to win all those liquidations? And let's use a hypothetical example where there's $100,000 of liquidations available, but there's certainly examples where there's millions or tens of millions, even hundreds of millions of dollars at stake. Well, in the old way of doing things, you might do things like spam the network with a whole bunch of transactions, trying to get your transaction immediately behind the Oracle update, right? Because what you basically want to do is the Oracle update makes the collateralized debt positions available for liquidation, and then immediately behind that, right, you're the entity that wins it, right? But just imagine all of these trading bots competing fiercely for $100,000 opportunity. How much do you spend to capture $100,000? You spend a lot, right? And in the old way of doing things, everybody suffered. These were known as PGAs, or priority gas auctions. And this is those circumstances for those of us who are around there where you had these crazy spikes in gas fees, where all of a sudden it would cost thousands of dollars to get a transaction on chain. And it might be because just a handful of bots were going at war with each other in the public mempool, going after these opportunities, and everybody else suffered. But at the same time, well-resourced actors were sort of like, hey, this sucks. You know, what if I just bribed the miner? What if I just paid the miner 50 grand and I said, hey, I'll pay you 50 grand if you put my transaction right here? And there was evidence of that kind of thing happening, that sophisticated mining operations were cutting backroom deals so that large trading operations could get preferential ordering. Not great. Along comes this entity called Flashbots. They build a system to basically move all of this off chain, but basically make it open and permissionless. So now anyone could participate in this activity of bidding for preferred placement. And this, how you do this is you submit what are called bundles. And so what you basically do is you grab that Oracle update out of the mempool, public mempool, you put your transaction behind it, you submit it with a bid, and you say, if you put these two transactions in exactly this order on chain, here's what I'll pay for it. So it's $100,000 opportunity. I'm a trader. I say, I'll pay $10 to make 100 grand. But Andy's a trader too. He says, well, I'll pay $50 to make 100 grand. Robbie's a trader. He'll pay $100 to make 100 grand. And it goes around, as you might imagine, and it bids up pretty quickly to almost $100,000 to make $100,000. And all of these systems are happening at every block in real time all the time. This used to be called MEV Geth in the proof of work days. Under under proof of stake with PBS today, this is known as MEV Boost. And all these various actors sort of participate to try to win these ordering opportunities and to secure NFT drops, to capture SexDex arbitrage or arb between centralized and decentralized exchanges, to front run and sandwich and other folks. Now, in the world of Ethereum L1, the ordering is determined by the system called PBS. Well, with the L2, there are generally sequencers, right? And so sequencers take transactions. There are various sort of sequencer architectures, and I'm no expert about this stuff, but they basically get a transaction submitted to them, and they order them in some sort of first received basis or some sort of gas price basis. But again, now you have the same problem where you're going to have some sort of opportunity. You're going to have some ordering preference. You're going to have actors who want to take advantage of that because they can make a gain. Well, what do? Well, if the fees are very low, they just spam the network. And we've seen, ample evidence of that, of transaction spam hitting these L2s as, bots try to compete for opportunities. You also have things like co-location, which is there is a time element to all of this, meaning how soon can I detect that there's an opportunity and how quick can I respond? And it turns out that things like the speed of light begins to matter, because based on where the sequencer is, based on where your trading bot is, based on the number of network hops and the distance, you might spend a couple hundred milliseconds trying to figure out what's going on and getting your bids in, while someone else says, oh, I have a deal with the sequencer operator. I happen to know that they're located in Edinburgh. I happen to know which data center they're in. So I put my trading operation inside the same data center. In fact, I bribed one of the people at the data center to put my trading operation on the same network segment, maybe even on the same rack, right? Because that way I'm closer to the sequencer and I can pick up this information faster than others can, right? And then again, this is centralizing, right? Because now you have some deep-pocketed actor who can build the specialist relationship, who can capture these opportunities. They make more money, and then they can do more of this stuff, right? You might have other groups that say, oh, we don't allow any of that stuff. But there's hundreds of millions of dollars of opportunity of MEV accumulating, and maybe they take advantage of it. Or maybe it pushes on to the next block in that rollup. And so the reality is you can't sort of scrub this stuff away. There's no like wave your magic wand and it disappears. And there are very real implications to whichever architectures are picked, whichever policies are picked, because that determines sort of what the most economically attractive set of actions are. And the general thing you want to do is you just want to make it open so anyone can participate. You don't want to privilege the deepest pocketed or the best connected or the friend of the CEO, right? Because again, that's not great for the sense of equity in these networks. So again, a long answer to a short question, but these are complicated issues, that's for sure.
Yeah, it is. And I mean, the incentive model for the sequencers is a little bit wonky right now because, for example, Base is doing like $10 million a month just off friend tech pretty much. And why would they want to share that? Right. And so it's like, why would they? So I think that's been a pressing issue in the rollup space, but I've also seen other people discuss other more prominent issues to further decentralize rollups and sequencers. So I'm curious if you have some other prominent and more pressing areas of decentralization for rollups. And then I'm also just curious, generally, maybe you can tie these in together because it might be the same kind of issue with the economic misalignment is, do you think that the business model behind rollups is A+, A-, B+, C? What do you think?
Again, I may not be the best person to categorize, so comment on all this, but just in general, sequencer centralization is viewed as sort of a structural weakness for the rollup space. You have one sequencer, it's controlled by one entity. It just creates all the conditions for games to be played for manipulation. And so there's been a lot of work into the notion of decentralized sequencers. So you have multiple operators and multiple geographies, but it's a tricky problem, largely because these L2s offer very short block times. I think Arbitrum's 250 milliseconds. And so it's not an easy problem to decentralize that in a meaningful fashion across operators and geography and be able to do interesting things in under 250 milliseconds, merely because the network handshakes take that long sometimes. There is a lot of work in this area, and most of the major rollup operators have roadmaps towards decentralization, and there are specialist providers out there like Espresso and others who are working on this. So I would say this is an area of very active research and development, and I think there's been a lot of progress in that. So, over the course of the next year, I think one of the things that will be really interesting will be exactly how far do we get on the decentralized sequencer problem, and how far into production they are. I would say that so far, the economic opportunities that seem to be presented by the leading L2s like Optimism and Ardrum are pretty interesting. It's always tough to give something an A+, but it's certainly in the B+ to A range for that. In general, what we see in these spaces is where there is liquidity, there is economic opportunity. And so those rollups that are able to capture significant economic flow, like Base, have real economic opportunity. And so at the end of the day, it's the liquidity is kind of a good gauge of engagement, right? It's the old metric. Like, it's not so much do you build the tech, it's do people use the tech. And how do you know if someone's using your L2? Well, there's a whole lot of flow. There's a whole lot of liquidity. There's a whole lot of action on it. There are people who are building on it. I think Optimism has done a pretty great job with their OP stack and basically encouraging other builders to pick up their infrastructure and set up their own L2s. There's a lot of traction there. And so in general, I think that the L2 space is pretty vibrant. And there's a handful of leaders. I've mentioned a lot of them. And there's a large number of challengers who are coming up to do interesting things. I think one of the things that's interesting is, will we see like an app chain thesis here, where each game will be its own rollup? It'll be an island unto itself. It'll be a simple rollup that's supporting a single application that will then need to, the interesting question is, how composable will it be with other stuff that's out there? You have cross rollup or cross chain complexities that associate with that, but maybe provide a really simple, really fast, really cheap way to have on-chain transactions for your favorite multiplayer game, right? And so I think that all of these ideas are being tested right now, and it's a great ecosystem play. And by ecosystem, it's like, let the strongest survive, right? All the ideas are going to get tried. Some of the ones that succeed might be surprising. There'll be others like the five-legged mammal that don't succeed because it turns out that the ecosystem can't support them, and that's fine. You end up with four-legged mammals, right? And so, we're in sort of this Cambrian period of experimentation. It's interesting that it's happening during a bear market because it shakes out a lot of the noise. And so the best ideas rise to the top. And I said this before, but I'll say it again. It seems too early to call winners and losers yet. And it does seem to be that there's a lot of good ideas that are being pursued and a lot of positive progress being made.
I like the Cambrian analogy. And I just looked it up because I had heard that before, but I wasn't really sure what it meant. And it's the explosion of diversity at the beginning of the what is this? The Mesozoic era? No, the Paleozoic era of dinosaurs saw an explosion of biodiversity, and maybe that's when five-legged mammals were able to exist in the ecosystem. So yeah. I take it like, we've already seen a Cambrian explosion with the L1s back in 2017. And the sentiment back then seemed to be, these are Ethereum killers. There's going to be one that survives. We kind of realized that's not really been the case, but a lot of them have fallen off. So now we're kind of seeing this again, this like explosion of innovation that's happening in the L2 space and the rollup space. And the thesis seems to have changed. It seems that now there is enough room for all of these to survive, whereas in the past, maybe we weren't so sure. So I think my question here is, what are the missing elements in the rollup and the L2 space now to ensure the survival of the most successful rollups and L2s?
So it's interesting. L1s basically have to bootstrap their own economic security, right? And so you have Bitcoin, which has this huge head start because it was the first, right? You have all these mining machines which are deployed against it. And so you have this pretty massive basis of economic security on the Bitcoin blockchain. Ethereum is an alternate proof of work system. You got to realize that Ethereum came out of the Bitcoin community. The Bitcoin community is a fundamental bet on sound economics. And there's a bunch of people in that community who wanted to push the technological barriers, wanted to be really pro-innovation. And when they realized that the core of Bitcoin wasn't really interested in pushing the technological boundaries, they split off and formed Ethereum. And so Ethereum has this interesting head start in terms of the intellectual capital. You have a lot of really smart computer scientists, cryptographers, economic incentive, game theoretic folks, and others who have been, gravitating towards the Ethereum ecosystem. And now you have this massive research community surrounding it. Ethereum stood up a bunch of computers, got a bunch of folks to get behind it, and you had some economic security there. There was this time where there were, 12 great engineers who had a better consensus algorithm, who had a different approach, and they stood up other L1s and they said, hey, we're going to compete with that. And there are a number of L1s that are relevant, that have real flow on them. But when Ethereum switched to the merge and to proof of stake, the total economic security available on Ethereum went up dramatically. I think today the number is, $35-40 billion of total economic security. And that gives it a lot of heft. It's pretty hard to move that much economic security someplace else. It's also quite hard to stand that up someplace else. Now, L2s are something else entirely, because L2s inherit their security from the base L1. This is what makes Ethereum so attractive as a home for L2s, because you can inherit $40 billion, again, whatever the number is right now, of economic security underneath it. So you don't have that same cold start problem. You have a different set of problems. And so the L2 ecosystem evolution, I believe, will be quite a bit different than the L1 ecosystem evolution, because you have Ethereum as this very roll-up friendly environment with a ton of economic security as part of it. Now, basically what needs to happen with these L2s is they need to offer capabilities that are that you can't get on the L1, because there are some trade-offs associated with it, like ultimately you settle down to the L1. So generally they offer things like faster block times, and they offer cheaper transactions, right? And so that turns out to be pretty attractive depending on the sort of application you're trying to deploy. And then what these L2s do is they try to attract developers to build on their ecosystem. And it's interesting to look at sort of the top protocols, the top applications, and see, they're available on Ethereum L1, but what L2s are they available on? Because that's where the users are, that's where the liquidity is. And then you start to see, well, what new applications are being stood up specific to various L2s? So what are applications that you can only find on Optimism? What are applications you can only find on Base, right? Base has a pretty interesting example in Friendtech. Friendtech was sort of used as a case study, as an example of the sorts of things you could do on the Base blockchain. And Friendtech is exclusive to Base right now. I'm on Friendtech. Hey, buy me. I'm Matt Cutler. But at the end of the day, the most of these L2s are EVM compatible. They're often address compatible, so you don't even need to change anything. You just need to deploy on those L2s, which makes it pretty easy to add support. But it's not so much about, it's not just getting up on the L2, it's about supporting the L2 moving forward. And maybe there's certain assumptions that you make about Ethereum L1 that are different over there, or that things start to work differently, and now it becomes more costly as a development team to support your application in these multiple locations. It also gets more confusing for your users, because was I using the application on Arbitrum, or was I using the application on Ethereum, or was I using it on Optimism or Base, right? If I want to move my assets between them, am I able to do so? How does that happen? What are the risks? If I'm part of a challenge, like a fraud proof sort of thing. What's that mean? What are the assumptions? And so you do get additional complexity that gets put on both the teams and on the end users as they go down these various paths. It's not a panacea. It's not something for nothing. It's always a trade-off. And so you asked the question around what's missing, and I think that in general the infrastructure's emerging, the developer tooling is emerging, and the best practices are emerging as well. And so I think everybody's in this period of experimentation, trying to figure it out. I think we'll start to see examples that really work, that people can look at and learn from and say, oh, they did it this way, I can do it the same way again. Or they use this tooling and they can do it the same way. It's very relevant to us at BlockNative because we are very actively trying to build sort of next generation observability infrastructure for Ethereum L1. And we are right now actively submitting grants to other foundations to say, hey, we have this grant from the Ethereum Foundation to build these capabilities into Ethereum L1. We think it would be in your ecosystem's best interest if the same capabilities were available for your L2. Not, by the way, unlike sort of what Etherscan does, right? And so, basically part of the tooling infrastructure, the picks and shovels, if you will. So all of that's still coming out is probably the best way to put it. But there's a lot of teams like ours who are pursuing these opportunities.
Yeah, awesome. Yeah, that's it's very interesting takes. I think we are almost ready for like onboarding a ton of users. Like I think the whole PWA friend tech was mind blowing. I think the L2s are there, but yeah, it's still just being built. It's exciting. Definitely far more ready than 2020, 2021. So exciting in that sense. Shifting gears to another hot narrative, pressing topic, exciting one that a lot of our fan base and community is excited about is the whole liquid staking narrative and what's going on there. The specifically, I'd like to talk about restaking. So if you want to maybe provide us with your general mental model of the landscape of liquid staking currently, if it's played out as you expected, things that you've noticed, trends, things you're excited about. But generally, we would like that to take us into restaking and some of the controversies around restaking.
So two related topics. So liquid staking is you stake with a large staking pool like Lido, which is the largest, and you receive back a token that you can then do stuff with, and you can buy, sell, trade. You can put it into DeFi applications, and this has created it brought a lot of people into the staking economy because it's a lot more fluid, it's liquid than just I lock my ETH up and it sits there and it accrues an APY. And then if I want to withdraw it, I got to submit a request and it gets put into the withdrawal queue and taken out. It becomes a lot more dynamic. What's happening with liquid staking in general is you can now move your stake moving forward, be able to move your stake much more fluidly between providers. And so, think about it like a bond market where you have various yields, and you get locked up into a bond. And so you say, okay, my bond is at 3%, and then a few weeks later, there's a bond that comes out that it's 3.5%, and you're like, now I got to sit around and wait for my bond to mature so I can move it to the 3.5. The liquid staking stuff allows you to move this between providers much more rapidly as you pursue maximum yield. This is great if you're an ETH holder because it allows you to get maximum benefit from that. But it's problematic from the position of the network because it creates centralization. If you have certain providers that are doing things others aren't doing, or have access to trading entities that others don't have, or there's some sort of other mechanism that's not explicit, they can offer additional yield, that all the stake will just flow to them. And they'll get more economic resources so they can do more of that sort of stuff. So there are concerns that you're going to have sort of fundamental centralization at the validator layer, which will create, conditions where you could have people who could be maliciously attacking the network. And, Lido is probably the best known because they're pretty close to the 33% threshold. That community has said very clearly they're not going to exceed it. But again, it's like, there's nothing structural to prevent that from happening. It's the ecosystem alignment of that community. And there's a whole bunch of stuff there. But I think in many ways, liquid staking is inevitable and is good for users. You don't want to put artificial constraints on folks' ability to move value around. The whole idea behind these Web3 systems is that they're programmable value. And therefore, the system should encourage innovation, should encourage experimentation. But, the question is, how do we create economic incentives that don't pin us towards some negative outcome? Now, restaking is a derivative of this, meaning imagine once I have staked my ETH, I can then stake on top of that again. I can secure additional applications, additional protocols using the ETH I've already staked. Well, it's basically like creating a preference stack. So if you are a startup, you have what's known as a preference stack. You have a series of investors that have put money in at various stages, and in the event of an asset, of a sale, right? You get acquired or something like that. There's an order in which your investors get paid out depending on the timing of their money. And this is all legally constructed when you do your investment. So it's not like everyone gets paid out all at once. It's that there's a stack of preference, right? The same is true with restaking, where you can now layer things on top of your staked ETH and your other staked assets, and you can get more yield as a result of it, but you put new constraints and you have new rules and you expose yourself to new risk, right? So at the end of the day, one of the fundamental rules of investing is anytime you're making yield, it's because you're assuming risk somewhere, that there's no such thing as risk-free yield. There is low-risk yield. The U.S. government bonds are a good example of low-risk yield, but they're still, you're basically, the risk is you're assuming the U.S. government is going to pay off its debts, which, as we've seen with recent events, that's not always the best assumption to make. As you do these restaking applications, you now create all sorts of complexities and all sorts of leverage on top of the base underlying asset of Ethereum. And while this is perceived as good and healthy insofar as it enables experimentation and greater economic security, and now you can have folks who can build what look and feel sort of like alt L1s, but aren't actually an L1, they're restaking applications, right? So it allows the economics of Ethereum to be much more fluid. It also gets really unclear what the risks are. And does that introduce things like consensus instability? And are there brand new attack vectors that would result in people losing? So you get a few more percentage points of yield, but you potentially risk, a very significant amount of staked ether underneath it. And does that then create lack of confidence in the system? And so there's a pretty healthy debate right now around, is restaking good or bad? I think most folks in the ecosystem would agree that restaking is inevitable. It's happening. The number one sort of leader of all of this is an entity known as EigenLayer, who's been quite transparent and quite explicit about their work here and their smart contracts. And I think we're still at the very beginning of all of that. EigenLayer, the protocol is live, though it's sort of constrained right now. But basically, every time they've tried to open it up, it immediately sells out. So there's clearly demand for these services. Why? Because people want to earn more yield, which is completely understandable. And I think a lot of the researchers are trying to figure out, what are the risks and how do they interact with each other and how do we manage that? So like I said before, I think the history of restaking is yet to be written. A lot of opportunity, a lot of potential, but also a lot of unknowns surrounding it.
Vitalik has written a bit about this with respect to, I think leverage is a great word, leveraging the consensus layer. And that, from my limited trading experience, leverage implies liquidation. So if we leverage the consensus layer too much, it's at risk of liquidation. And then from the L1 getting liquid, the security of the L1 getting liquidated in this sense implies that all the L2s that are based on, not just based on, but inherit the consensus layer security from Ethereum are liquidated from that as well. What does that look like? Like if restaking goes so far, Eigenlayer says, screw it, we're open the floodgates, everyone restakes, we leverage up the consensus layer to the gills. What does liquidation mean for the consensus layer?
Well, I think my belief is the answer is we don't really know, and that's scary, right? That as you introduce very high levels of restaking, high levels of leverage, there kind of is no foundation anymore. The foundation gets unclear, and you can have bugs, you can have attacks, you can have shocks to the system that it becomes very hard to predict sort of what the outcomes are going to be, and that may undermine overall security. It may undermine consensus. It may, create all sorts of nightmare scenario outcomes become theoretically possible, right? But that's one of the interesting things about these systems, about L1s, about L2s, about restaking, is they're very hard to model in theory. They're very hard to model in testnets, because it turns out that when you have real money involved, and you have real economic, you have geopolitical events, and you have stock market crashes, and you have, labor strikes, and you have risk of government default and government shutdowns, like it affects these complex economic systems in ways that are not easy to model and not easy to predict in advance, right? And of course, you can have multiple of these events happening at the same time that then create all sorts of wedge conditions or sort of pinch conditions, right? So I think this is, from the EF core devs, there's been a lot of writing about how there's so much complexity that gets introduced by restaking, that equals a lot of risk, and that risk is not very well understood. And in general, when it comes to the base economic security, less risk is better, right? Again, from the perspective of the network, that makes a ton of sense. But if you're a ETH holder and you can make 2% yield, 4% yield, 8% yield, or 12% yield, which one do you want, right? Or do you want someone in the middle saying, you know what, you can only make 2%? You're like, well, what do you mean? I thought this was open and permissionless. I thought I could do whatever I want. So there's no magic bullet answers here. There's no clean way to do it. I think the thing that most of the folks I know who are involved in is they just want to be really explicit about, at 2%, you're assuming one level of risk. At 12%, you're assuming 6 times the level of risk, right? And that may be, there may be much more severe consequences for that. And I think the concern is, if all of the stake rushes to 12%, assume 6x the risk, then there could be some real challenges for the base economic layer, and therefore the security of the L2s. What will really probably happen in these circumstances would be less of a catastrophic economic event and more of a real shaking of confidence, where people sort of go, oh, I thought this Web3 stuff was ready for prime time, but maybe it's not. I'll just sit on the sidelines. And so I think that a lot of what we're trying to do in the Ethereum ecosystem is demonstrate that we've reached a new level of maturity, we've reached a new level of being solid, and that institutional funds can start to participate in ways that are meaningfully interesting to them, but also don't expose them to unknown consequences that they're going to be unhappy about down the line.
Yeah, you segmented it perfectly. I was just going to say, this week we had the futures ETF pass, and this conversation has been entirely about Ethereum. And I know that you're very well entrenched in the circles of, should we say, humbly influence out there in the West Coast of the States. So what's going on in the social circles over there? What's your vibe on the institutional inflows? What's the big boy, liquidity trying to do? Is it ETH? Is it Bitcoin? Is it, are these things that these guys are thinking about? Are they considering staking? Is that appealing? Too much risk? I'd love to just kind of hear, as we wrap up, a summary kind of what you've been hearing and what you think has been going on behind the scenes.
Well, so among the builder community, we're still in the heart of crypto winter. It's heads down and build. This is not a time of crazy token launches. This is not a time of mass evaluation and big fundraising. So it's very sort of heads down, serious, making stuff happen, which is, of course, for folks like me, preferable to the alternative. Among, it's always hard to sort of paint too broad of a brushstroke, but certainly the world of crypto has been on the minds of institutional investors for a while now. And in particular, you have high net worth clients who are seeing dramatic yields, right, or seeing dramatic returns. And they go to their existing providers and they say, I want access to that. And the providers say, we don't touch that. And they go, I thought you were my financial advisor. I thought you were managing my funds, and you're basically limiting me in this class of assets. You'll give me assets to raw materials. You'll give me assets to access to real estate and to equities and to bonds, but you're not going to give me access to digital assets. Well, I guess you're not my wealth advisor anymore. I guess you're not my financial partner, right? And so I think many of the large financial institutions realize that for them to service the needs of their clients, they need to be conversant in the category. No question about that. Pretty much universally, they've all stood up teams. They've all begun experimentation. And I think what they're seeing is encouraging, right? That there is growing regulatory clarity. There is sort of growing stability in the markets. There is a small number of players or small number of asset classes that seem relatively solid, relatively serious, relatively investable. And the smart ones are going in and getting hands-on. So I am personally aware of some very large players who are very actively working on staking projects, right? Whether it's themselves or through partners. And the reason is not because they want to drive a whole bunch of yield. The reason is because they really want to understand the problem very well. And they know that if they're going to incorporate this into their operations or they're going to advise their clients on it, they can't do it from the cheap seats. They got to say, hey, here's what we did internally, and here's what we know, and here's what we learned, and here's what we recommend to you. So I do not anticipate massive inflows or sudden shifts, but it seems pretty clear from the BlackRock ETF filing all the way down that the largest financial institutions are paying attention, are interested, want to do relevant things, and are doing the homework, right? And that, I think, is long-term bullish for the category. It's just going to take a little while to get there. So we didn't touch on this, but you have things like EIP 4337, which is, or not EIP, ERC 4337, account abstraction, which makes this stuff much easier to use. And, theoretically, and I've talked about this publicly, your credit card could become a crypto wallet with its own private keys. And you can do all sorts of super cool stuff about airdropping NFTs into Visa cards that are on file at Spotify based on your listening habits, right? So suddenly things get super cool.
Don't tease me. Yeah, I wrote a long form post about intents today, and it was just like, this off-chain, on-chain combination of intents is just like boom.
Yeah, there's a lot happening. And again, I think this is probably the best thing is building, making things easier, making things, more attractive to get involved in, and just taking this all seriously, not being, crazy pump and dump or crazy speculative. I think that's long-term healthy for the ecosystem. And that's why we're still here. That's why we've been building for 5 years. That's why we plan to be building for the next 5 years.
One moon.
Any minute now.
Dude, thanks, Matt. Thank you so much, man. Such a fun time to just sit back and relax for almost an hour and just get schooled. So thank you, sir.
You bet. My pleasure. And again, thanks for having me on, and looking forward to seeing everybody out there. Check out BlockNative. Check me out on Twitter, or X, I guess it's called now. And let's keep building, everybody.
Build. Thanks, Matt. This was tons of fun.
Cheers.